Thank you for joining us today. My name is Burke Purcell. I'm the CEO and founder of LoanBud. And today we are going to be talking about SBA lending in a partnership between LoanBud and Transworld Business Advisors. Before we get started, I want to give you a background on LoanBud, who we are, and how we help service the business brokerage community. LoanBud began as a division of a public bank and a top 10 national SBA lender. At the end of 22, we parted ways with that bank and we became an independent marketplace to be able to open up our credit box and better serve our customers and our partners. So today we work with over 50 SBA lenders on our platform, and we are the only marketplace in the United States that is fully dedicated to SBA lending. A bit about myself. Again, I'm the founder and CEO of LoanBud. I have over 2 decades of experience in lending. I've grown and scaled multiple lending operations and sales teams, most recently with LoanBud. I am an advocate for the self-employed community. I believe entrepreneurs and self-employed individuals are really underserved as it relates to lending. And over the past decade, I have been only serving the business lending needs of the entrepreneurial community. I saw a number of inefficiencies when I was tenured of the bank that we ended up leaving. And that's part of what inspired my vision for creating LoanBud as an independent marketplace. So why do we exist? LoanBud is here to solely help business owners access SBA financing. We are modernizing an otherwise very archaic process. So SBA lending is as traditional and old school as you can get in the lending world. So think a bunch of PDFs being emailed unsecurely to lenders, inconsistent tracking and lack of transparency, and folks using Excel spreadsheets, and it's really a very inefficient process. So LoanBud has set out to change that. And again, we are going to empower entrepreneurs and ultimately preserve Main Street. There are some key benefits to an SBA marketplace. First being that we are not captive to a single lender. So in SBA, lenders set their own credit policies. So if you're only working with one lender and they say no, then you can sometimes have lost weeks or even months going down a path with a lender that ends up not closing. So because we work with over 50 lenders on our platform, we have the widest credit box in the industry by a long shot. So with us, if it's possible to get done SBA, we're going to get it done. And we have curated the lender network that we are working with today. So SBA 101, from a very high level, what is the SBA loan program? So the SBA is a government agency. What a lot of people don't understand is the SBA does not do the lending. It's up to the individual approved SBA lenders to lend the funds and to ultimately make their own credit decisions. So SBA loans are great for lenders because it reduces the risk that is otherwise associated with a business transaction, a business acquisition transaction. So the lenders really appreciate the SBA program because the government comes in and they guarantee a large percentage of the loan that is made. Typically, that guarantee is going to be 75% of the loan amount. So on a $1 million loan, the bank is on the hook for $250,000, whereas the SBA and the government is backing $750,000. So it's a lot less risky for the lender. And it is by far the most common financing that is used for business acquisitions. Why does this all matter for brokers? Well, most of your buyers are probably going to need financing to be able to close. We estimate about 70% or even more of buyers need some sort of financing And chances are that's going to be through the SBA. So you're going to have questions from sellers and from buyers on the SBA and its process. So we want to educate you as much as we can on a high level so that you can help answer some of those questions. SBA loans offer longer terms, lower down payments than any other program in the market. And ultimately, your listings, if they are SBA financeable and they're SBA pre-qualified, you're going to get more traffic, which is going to result in higher offers and faster closing times. Some highlights of the 7A loan program. Loan sizes are typically going to be between $350,000 and $5 million for the standard 7A program. There are loans that can be made less than $350,000 under the 7A small loan program. We can support transactions from $200,000 and up. Anything less than that is pretty challenging for most lenders to get done. And what's great about SBA 7A loans is that you can use them for multiple purposes. So in addition to buying a business, all in one loan, you can also include things like real estate. So if the business is being sold with real estate, you can finance everything with one loan. You also can include working capital. You can buy equipment. Business owners can also purchase inventory. There's a lot that can be done with this kind of all-in-one loan program. Construction, leasehold improvements, building improvements. I think anything that is eligible from a business standpoint, the money is being used for the business, chances are it's eligible under the SBA 7A loan program. Terms are going to be up to 10 years unless there's real estate involved. Then we can stretch the term out to as much as 25 years. So if a business is being sold with real estate, the term is going to depend on how much of the total deal is real estate versus the business that's being sold. So if the real estate component comprises at least 51% of the total deal, then the entire loan goes on to a 25-year term. If the CRE is less than 50% of the deal, then we would look at a blended terms somewhere between 10 and 25 years. Down payments are going to be 10% at a minimum. There is a way that the buyer could come in with 5% cash if the seller is willing to hold 5% note on standby. But typically, we like to say 10% cash is going to be the most common structure. And then interest rates are going to be set by the lender. They're capped by the SBA. It's almost always going to be prime plus a margin, and that margin can be up to 3%. Basic SBA eligibility, we're going to be looking at US-based businesses that are for-profits and no nonprofits. Most for-profit industries are eligible with the exception of speculative businesses, so things like real estate investing or any kind of vices. So gambling or marijuana, things along those lines will be ineligible. We do need to see that the buyer has relevant experience. Now, that could either be direct experience or it could be transferable, but they do need to have appropriate experience based on the target opportunity. The business that's being sold has to have sufficient cash flow to be able to support the new SBA loan that's being taken out to buy that business, and that we can't have any major red flags such as tax liens, lawsuits, etc. What disqualifies a deal? So right off the bat, if the buyer doesn't have the cash to come in, it's not going to be a great deal. Experience is another big component here. The level of experience being direct or transferable will really depend on the target opportunity, what kind of licensing, if any, is required. I'd like to use the example if someone's buying a restaurant, are we talking about a pizza shop or a fine dining French restaurant? Those two opportunities require very different skill sets and backgrounds. Poor, messy seller financials can always be a little bit tough. Cash deposits that we can't use, if they're not on the tax return, they really can't be used with SBA lending. speculative or ineligible industries are all going to rule out deals. This is the most likable deal structure by SBA lenders. If you can structure them this way, a lot of lenders are going to like your deals. We call it an 80-10-10. So 80% financing by the SBA 7A lender, 10% buyer cash, and then a 10% seller note. Now, please note, this is not a requirement. If the business has strong enough cash flow, we certainly do a lot of deals where it's just a buyer coming in with 10% cash and the lender is financing the remaining 90%. Your role as a broker, you have a few different roles. The first is you want to spot financeable listings. So these are going to be the listings that have good cash flow, clean books and records. You want to encourage that the buyer gets ready up front. So speaking with a marketplace like LoanBud or even working with a direct lender to get that buyer pre-qualified early in the process is a really good idea. What you don't want to do is engage with a buyer, enter into an LOI, and then find out that that buyer is unable to perform. It's not going to make you look good with your seller. You'll have egg on your face. So what we do at LoanBud is we will actually screen the buyers for you. So we'll run a soft credit check, make sure that we're at least at a 650 score. We'll also check liquidity and make sure there's enough funds to be able to come in and close. And we will also verify the experience of the buyer and make sure that it aligns with the business they would like to purchase. On your end, you also want to set realistic expectations for the seller. So pre-qualifying a business for SBA financing is a wonderful idea because you're going to attract new buyers, in turn get a higher sale price, likely a faster close. It's going to be a really smooth process for all parties. There is going to be some requirements we have of the seller. The seller is going to have to give us the documentation that we request. So we're going to want to make sure the seller understands that they're going to need to provide documentation throughout the sale process. We will have to have updated books and records, year-to-date profit and loss statement dated within 60 days, year-to-date balance sheet dated within 60 days, and those will need to be refreshed to make sure that we're always staying current. I recommend involving LoanBud early in the process to reduce any friction. Understanding SDE and add-backs. So sellers' discretionary earnings is a term you'll hear a lot of, and it's going to be the net profit plus any allowable add-backs. Now, SDE from a marketing standpoint might be very different than SDE from a lending standpoint. So I'm going to speak about what lenders can use in terms of add-backs. And so the most common add-backs are going to include the owner's salary and any benefits that the owner is taking, understanding that the new owner is also going to take the salary. So in many cases, this ends up being a wash, where we see improvements as if the present owner is taking higher salary than what is needed by the new buyer. For example, the present owner is taking a $300,000 salary, and that's way more than what the new buyer would need. That's an area where we can have a legitimate add back in the additional owner's compensation. When we add back owner's compensation, we can also add back payroll taxes, any kind of benefits that the owner is taking, like health benefits or any retirement benefits. And then we can always add back one-time expenses if they can be documented. These might be things like legal fees or maintenance and repairs if it was a one-time expense and we can document it. And then the other standard add backs will be interest, depreciation, and amortization. Anything above and beyond that, we really have to look at it very closely and carefully on a case-by-case basis. SBA lending, again, the SBA does not do the lending. It's the lenders that set their own credit policy. So there is a standard operating procedure, an SOP, that is published by the SBA. And there are always iterations of the SOP. When they come out, LoanBud can update you in terms of how it might impact potential deal structures. But the SOP is just a framework for eligibility. The actual credit decisions and credit policies are always going to be set by the lender. And so these policies can really vary widely based on collateral requirements, minimum FICO scores, debt service coverage ratios, NAICS codes. So what industries will the lenders allow? The amount of equity injection that the buyer has to come in with, and then also the internal approval processes of that lender. Here's some common credit overlays that we see. They tend to be pretty inconsistent and uncertain, but many lenders want to see real estate collateral once the loan size gets over a certain level. So that might be 1.5 million, 2 million, 3 million. With the larger loans, the lender has more exposure because the SBA is only guaranteeing 75% of the loan. On $5 million SBA 7A loan, the lender's on the hook for $1.25 million. So they want to make sure that they have some collateral in many cases. So if a buyer is really good on paper, but they don't have real estate to be able to pledge, for certain loan sizes, there's going to be a lot of lenders that will walk away from that deal. Lenders also put overlays in for FICO scores. The SBA does not set a minimum FICO score, but some lenders want to see a 680 or a 700 or a 720. Many lenders also want to see multiple years of historical debt service coverage ratios meeting a certain level. Typically, it's a 1.25x debt service coverage ratio, and a lot of lenders are going to want to see that for the last 2 filed tax returns. That can be challenging, but it's what a lot of lenders want to see. There are also a lot of restrictions as it relates to the industries. So if a chief credit officer got burned on a FedEx deal 7 years ago, he's still not lending to FedEx companies today. That happens all the time. Lenders will just say, we're not going to lend to privately owned restaurants or hotels or whatever the case may be. And a lot of times that has to do with a deal that went bad many years ago. Most of the time, loan amounts will be limited to $5 million, which is the SBA 7A cap. We'll talk about ways to get over that here in just a minute. And then once you get past all of this, if the loan is over a certain level, you still have to go through credit committees. You have a group of 5 or 7 people sitting around talking about the deal and subjectively deciding whether or not they're going to approve. And this is the LoanBud way. So LoanBud, we do not require collateral regardless of the loan size. So this is all the way up to $5 million. Now we have to follow SOP, of course. So if real estate collateral is available, so if the buyer owns real estate and the buyer has at least 25% equity in that real estate, then the lender needs to take that real estate as collateral. This is an SBA rule. So we have to follow that, but we're not going to say no just because a buyer does not own real estate. So that's a real huge advantage that we have. Personal FICO scores just need to be 650 or higher for the buyer. This is a big one. We only want to see the last filed tax return hitting a 1.25x debt service coverage ratio plus the year-to-date financials. So again, many lenders want to see 2 years, sometimes even 3 years of historical cash flow. And this is only going to be 1 year that's required. There is no credit committee. So if it meets the entire credit criteria, it's a single pen up to $5 million, provides certainty of close. And lastly, we can offer pari passu loans. And what that means is SBA 7A loan up to the maximum loan amount of $5 million paired with a conventional bank loan up to $3 million. So this can allow you to start to service the lower middle market deals in the 9, 10, $11 million range can get done with as little as 10% cash from the buyer, a $5 million 7A loan, a $3 million conventional pari passu and maybe a small seller note as well. Buying a small business is a lot harder than it should be from a financing perspective. There is not a clear path. Buyers don't have an easy way to Amazon with one click and check out. There's a lot of financing roadblocks. Deals fall apart all the time. And the time to close, it can really be a long time. With many lenders, they're going to take 4, 5, 6 months to be able to close. And a lot of deals do fall apart. So it's important that you do your diligence up front and you work with someone that's going to be able to come through and get your deal closed. So in May of 2025, we introduced LoanBud.io. And this is something that all Transworld brokers have access to. It is a first of its kind software that we built specifically for the purposes of pre-qualifying listings for SBA financing. In a moment, we're going to do a demo to show you how it all works, but it's real simple. You upload a new listing, drag and drop the seller financials, and within 24 hours, you'll hear from someone on our team as to whether or not we can assist with that deal. And we can provide you a link buyers can use to be able to apply to buy that specific business. Some advantages to pre-qualifying your listings up front. And these are really advantages for not only the seller, but for the deal in general and for you. So number one, you're going to command a higher sale price. There's no doubt about it. So getting a listing SBA pre-qualified, if you could have that in your listing, you will attract more buyers. You're going to attract serious buyers. And so with more traffic and with more interest, you're naturally going to command a higher sale price. There's a lower risk of deals falling apart for loans that are SBA pre-qualified, because if you think about it, when we have all of the finances in line up front, we're working with up-to-date current financials, profit and loss statements, and balance sheets, and tax returns have all been vetted and verified. The deal's gonna not fall apart if we have all of that up front, and they're gonna close faster. So it is a faster sales process for listings that are SBA pre-qualified. For the same reason, we have a seller that has all their documents ready. The buyer, once they see that, now they just have to get their documents ready, and then we move everything together to get things going as quickly as possible. And of course, you're going to have increased visibility to serious buyers. Buyer pre-qualification is also an important side of the coin. So it's one thing to get the listing pre-qualified, but you also need to make sure that the buyers interested in purchasing your listing have the ability to be able to close. So what LoanBud does is we're going to verify all of these things up front. We're going to make sure that the buyer has the cash needed to be able to close on that target. We're going to also do a soft check of the credit and make sure that the buyer has at least a 650 FICO score. We'll run background searches, make sure there's no undisclosed liens or bankruptcies or criminal history. Not that these things are impossible to overcome, because it is possible to get an SBA loan with having a felony on your record or with having a bankruptcy on your record, but we need to know when, we need to know the circumstances and vet all of that up front. And then we also have to make sure that the buyer has the right experience, which aligns with the business for sale. On the listing side, you want to look for businesses that have stable or growing revenue and positive net income. We can't really pre-qualify listings that are showing a loss. We can add things back. So let us take a look at them. Things like depreciation, amortization, interest, owner's compensation can oftentimes turn a loss into a positive really quickly, but there ultimately needs to be enough EBITDA to be able to repay the SBA loan. If we have a business that is declining in revenue from year to year or even year to date, it's not impossible to get done, but we do want to address it up front, make sure that we can overcome it. Reasonable add backs only. So personal expenses are going to always be tough to add back. Someone put their kid through college or they put a extension onto their home and they want to add that back. It's going to be really tough to do that with a government-backed loan. And then we want to get the most recent tax returns for the last 3 years. We also want to get a year-to-date profit and loss statement and balance sheet. We see a lot of listings where we're asked to pre-qualify and we only have the last 3 tax returns. We have nothing for 2025. Well, we're halfway through 25. So how are we supposed to analyze that business if we don't know what's going on for the entire half of 25? So we do want to get the financials up to date and let the seller know that we're going to need things to be refreshed and kept up to date throughout the process. We want to see a debt service coverage ratio of at least a 1.25. That's something that our team will look at. And then the business, of course, needs to operate in an SBA eligible industry. So that's what I have from my end. I'm going to turn it over to Lanny Moore, who is going to talk a little bit more about LoanBud.io and the process for pre-qualified listings.